that's also undergoing a major transition. I suppose your borrowing profile constitutes, I think debentures constitutes a big portion, term deposits constitutes a big portion. Yeah, I got it here. 30% is term deposits, 23% is your term borrowing, and 11% is CASA. Sorry, debentures is 24%. So how is this likely to change?
Yes, the whole thing is that the trust would be always on deposits. Yeah, I'm sure that is a low-cost deposits, which is going to be a trust in this order. Because as I was outlining, the bank branches are completely staffed, and then they're going with in terms of improved productivity. Coming months, we will definitely see a better improvement in terms of CASA and then deposits. These are the three products which ultimately will be contributing more in the coming quarters to the overall borrowing, which will actually bring down the borrowing costs.
All right, Mr. Raghavan, we're going to leave it at that, but thank you so much for joining us and detailing the quarterly numbers for us and taking us through understanding the numbers better from the transition standpoint to a small finance bank. But Kiran Mazumdar Shaw, CMD Biocon, is speaking at the earnings conference. Let's listen in.
So has impacted our numbers. We've also seen a delay in certain regulatory approvals and tender delays in certain emerging markets, which have also basically muted our earnings this quarter. And of course, this all has been compounded by the fact that the Malaysia carrying costs, of course, has impacted our P&L, which is something that is inherent to our business as we move forward. So all in all, I would say that, we have seen a very muted set of numbers this quarter. And of course, even if you take it as at a half-yearly level, we have been impacted because of Q2 numbers. Based on these, if you look at the financial numbers that we have, that I would like to comment on, our total consolidated revenues has seen a modest growth of 3% from 993 crores last fiscal to 1019 crores this fiscal. At an operational level, again, the growth has been very, very modest of 2% from 955 to 969 crores this fiscal. If you look at segmentally, our small molecules is the one that has really impacted our growth in a significant way. It has basically degrown 13% from 403 crores last fiscal to 351 crores this fiscal. Our biologics business has remained flat at 156 crores, and as I explained earlier, this is largely attributable to the plant shutdown that we have taken in order to comply with certain regulatory requirements. So we expect, some of the growth to come back starting Q3, but the real growth anticipated in biologics will actually show robust uptick from FY19 onwards. The two businesses in our segmental review that I'd like to also talk about in a positive way are the research services business, which is Syngene's business. That has shown a sharp recovery this quarter. And this is largely on account of our dedicated centers as well as our chemical development business, which had seen some muted growth in the previous quarters, but this has sharply recovered, and we expect that this will remain so for the rest of this fiscal and onwards. So I think that has been a very positive contributor to our numbers this fiscal and this quarter. In terms of branded formulations, this has certainly shown a sharp uptick, 29% year-on-year growth this quarter. I must, of course, mention here that some of this has had a restocking due to the GST impact that we had faced last quarter. But therefore, when you view at a half-yearly level, the growth is modest. It's about 4%. But if you look at it at the Q2 level, it's a sharp 29% increase. And I would say that going forward, we are likely to see a good healthy double-digit growth in this particular segment. I would also like to mention here that interest and depreciation costs have increased from 207 crores, which is a 44% increase in our interest and depreciation costs. Again, largely attributable to Malaysia. R&D costs, of course, are at 93 crores. Which really represents 9% of our core business, excluding Syngene, that is. EBITDA stood at 233 crores for this quarter, and the EBITDA margin was at 23%. Of course, if you look at core EBITDA margins, which is net of licensing and forex and R&D, it stood at a healthy 27%. Net profit for the quarter obviously was very sharply impacted, and it was at a 69 crore level, which and at a net profit margin of 7%. So I think overall you can see that we have had a challenging quarter, but we expect that some impacts that I mentioned earlier on should ease up, and I also believe that these headwinds that we are facing will ease off by the end of this fiscal, and we expect to start FY19 on a much stronger note.